Hello everyone. Welcome to EduTap and welcome to today's session. So in today's session, we are going to discuss a very important press release that is regarding the counter-cyclical capital buffer. So we will discuss that what recent decision the RBI has taken regarding the counter-cyclical capital buffer, and we will discuss the framework regarding the counter-cyclical capital buffer. When is it initiated? How is it initiated? And what is the main indicator according to which it is indicated? So this framework was discussed in the newspapers also, and that's why this framework becomes very important for us to understand. Okay, so we will discuss the press release that is released by the Reserve Bank of India regarding the counter-cyclical capital buffer, and we will discuss the framework also, so that you have the clarity, you have the idea that what the counter-cyclical capital buffer is all about. And let me tell you that this is very important from your objective and descriptive point of view for the RBI examination, for the other regulatory body examinations also. Okay, so let's get started. Give me a thumbs up if I'm clearly audible and visible, and let's get started. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. And good morning to all of you. Welcome to the session once again, and let's get started. So the Reserve Bank of India has recently reviewed the requirement of the counter-cyclical capital buffer, and according to this, the RBI has released the press release. RBI has released the press release. Now let's see that what decision the RBI has taken. So Reserve Bank said that it has decided against activating the counter-cyclical capital buffer. So RBI has decided to not activate the counter-cyclical capital buffer. Okay. So this is the decision that the RBI has taken, as it is not needed in the present circumstances. Okay, so I hope you know that against the risk weighted asset, the banks, the loans that the banks are providing, these loans are the asset for the bank, because on these loans the banks are earning the interest. So banks are providing the loan on which the banks are earning the interest, so this loan is the asset for the bank. Now with the loans there are some risk weight that is attached. Okay, if the loan is given to corporate, the risk weight is, let's say, 100%. If the loan is given for the house, let's say the risk weight is 50%. If the loan is given to some MSME, let's say the risk weight is 125% or so. So with the assets, with the loans that are given by the bank, there is some risk weight that is attached. Okay, so now there is the risk weight asset. That means with the loan that the bank is giving, there is some risk that is attached, that what if the loan does not come back, what if the money does not come back. Okay, so this is the risk weighted asset. So against the risk weighted asset, the bank has to maintain the capital. The bank has to maintain the capital. Now the capital that the bank is maintaining, against the risk weighted asset, it is known as capital to risk weighted asset ratio. So capital that the bank is maintaining against the risk weighted asset is CRAR, that is the capital to risk weighted asset ratio. So bank has to maintain some capital against the risk weighted asset so that the bank can handle the distress or the problematic situation. Now what is the CRAR for the banks? Can you tell me the percentage of CRAR for the banks? Tell me very fast, what is the percentage of CRAR for the banks? Particularly for the banks I am asking. It is 9%, right? So the capital that the banks have to maintain against the risk weighted asset, that is the capital to risk weighted asset ratio, this is 9% that the banks have to maintain, out of which the tier 1 capital that the banks have to maintain is how much? And the tier 2 capital that the banks have to maintain is how much? Anyone? So tier 1 capital that the banks have to maintain is consisting of your common equity tier 1 capital and your 81 bonds that are the perpetual bonds. Okay, so tier 1 capital, this is the liquid kind of capital that the bank can use during the distressful situation. The bank can use whenever the bank is in a problematic situation, whenever the bank is facing any problem and the crunch the bank is facing. So bank can use this tier 1 capital that we have discussed in the previous session also, that it consists of the reserves of the banks, it consists of the profit or the part of the profit that the bank is keeping with itself. Okay, so this is the tier 1 capital that consists of common equity tier 1 capital. This is the most liquid capital that the bank has, that the bank can immediately use in the distressful situation. Okay, AT1 bonds, these are the perpetual bonds through which the banks can raise the money. So AT1 bonds, the tier 1 capital, the banks out of the 9% of the CRAR, out of 9% of CRAR, tier 1 capital should be kept at least 7% of tier 1 capital the bank should be keeping, out of which common equity tier 1 capital should be 5.5%. This is the minimum common equity tier 1 capital that the bank should be maintaining, and the rest 1.5% can be in the form of AT1 bonds. Okay, so this is the idea. So I hope this is clear that tier 1 capital, the bank has to maintain the minimum tier 1 capital of 7%, out of which 5.5% should be in the form of common equity tier 1 capital. That is the most liquid kind of capital. The rest 1.5% can be in the form of perpetual bonds or the bonds through which the bank is raising the funds. That is the AT1 bonds or perpetual bonds. Okay, tier 2 capital can be like the rest can be tier 2 capital, that is 2%. Okay, now it is said that the bank should be maintaining some buffers. What are these buffers? Do you know that what are the buffers that the bank should be maintaining? This is known as capital conservation buffer. Capital conservation buffer. This is the buffer that the bank should be maintaining in the day-to-day manner, or the bank should be maintaining this buffer. Okay, so capital to risk weighted asset ratio is 9%, but the bank should also be maintaining the capital conservation buffer, that is 2.5%. Now this buffer should be maintained in the form of common equity tier 1 capital. Okay, so common equity tier 1 capital, the common equity tier 1 capital that the bank should maintain is 5.5%, that is under the CRAR, but the bank should maintain the capital conservation buffer. This is the buffer that the bank should maintain. This is the extra capital that the bank should maintain. This is 2.5%. That should also be in the form of common equity tier 1 capital. Okay, so this is the overall idea. I hope all of you are aware about this, but if you are not, so this is static, but I have told you the basic idea. CRAR is 9% for the banks, out of which tier 1 capital and tier 2 capital. Tier 1 capital should be minimum 7%, out of which common equity tier 1 capital, that is the most liquid kind of capital that the bank has, should be 5.5%, and the AT1 can be 1.5%. Okay, tier 2 capital is 2%. So tier 1 capital is 7%. This is minimum tier 1 capital that the bank should maintain. Okay, so this is the idea. Now, if the bank is maintaining the additional 2.5% of capital conservation buffer, so this should be in the form of common equity tier 1 capital. Okay, so additional 2.5% of buffers the bank should maintain in the form of common equity tier 1 capital. But now the RBI is saying, or the RBI has said, that let's say that there is a big problem that is going to come in the country. There is some distressful situation that is going to come in the country, and the RBI is getting aware about this problem, that in the future the problem can come. So RBI is saying that there can be counter cyclical capital buffers that the RBI can mandate the banks to follow. Okay, and this framework we have to understand. So this is the general criteria that the banks follow, and this is the general criteria that the banks follow under the Reserve Bank of India. But if there is some problem that the RBI is feeling that is going to come in the future, the RBI can also mandate the banks to have the counter cyclical capital buffers. Okay, the RBI can also mandate the banks to have additional counter cyclical capital buffer that will be in addition to this. Any confusion here? Any confusion in this? Is it clear? So counter cyclical capital buffers, these are the additional buffers that the RBI can mandate the banks to have in case the RBI feels that there is some problem that is going to come in the country. So Reserve Bank of India has decided against activating counter cyclical capital buffer. That means right now RBI is saying that there is no requirement of counter cyclical capital buffer. The banks only have to maintain the 9% of CRAR and the 2.5% of the capital conservation buffer. That's it. The RBI has not activated the counter-cyclical capital buffer as it is not needed in the present circumstances based on the review that RBI has done and based on the empirical or the real life analysis that the RBI has done. Okay. Now let's move forward with the framework. So till now, I hope everything is clear. Now let's move forward with the framework. So the framework on counter-cyclical capital buffer, this was put in place by the RBI in terms of guidelines issued on February 5, 2015. So in 2015, RBI put in place a framework on the counter-cyclical capital buffer, wherein it was advised that CCyB would be activated as and when circumstances warranted. That means CCyB, this is the special kind of buffers. These are the counter-cyclical capital buffers that the banks have to maintain on the order of the Reserve Bank of India, and this order will be pre-announced. So the framework on the counter-cyclical capital buffer, that we have to understand. Okay, and this framework was also discussed in the newspapers, in the business line, in the economics times. So that's why this framework becomes important for you, as it was also present in the newspapers. Okay, so the internal working group of the Reserve Bank of India under the chairmanship of Sri B. Mahapatra had submitted the final report on the implementation of the counter-cyclical capital buffer. So remember that the internal working group of the Reserve Bank of India, under the chairmanship of Sri B. Mahapatra had submitted the final report regarding the implementation that should happen of the counter-cyclical capital buffer in July 2014. This report was finalized and was submitted to the Reserve Bank of India, and the final guidelines that were issued in 2015. So the report was submitted by the working group in 2014 and the guidelines were finalized in 2015. The report made recommendation in areas such as the indicators that may be used for the decision that the counter-cyclical capital buffer should be initiated or not. Okay, so in the recent press releases, counter-cyclical capital buffer is written in this manner, but in the previous guidelines of 2014-2015, the counter-cyclical capital buffer is written in this manner. So they both mean the same. Do not get confused. Okay, so the report made recommendation, the report that was presented by the working group under the chairmanship of Sri B. Mahapatra, the report made recommendation in areas such as the indicators that may be used for the decision that the counter-cyclical capital buffer should be initiated or not, thresholds for activating the buffer, what should be the threshold on which the buffer should be activated, and lead time for announcement of the buffer, that how many days before or how many weeks before the buffer has to be, or the counter-cyclical capital buffer has to be announced. Okay, so here the aim of the counter-cyclical capital buffer regime is twofold. That means there are two reasons of initiating the counter-cyclical capital buffer, or there are two reasons for having the counter-cyclical capital buffer. The first one is that it requires banks to build up a buffer of capital in good times. So if there is the expectation that in the future something wrong is going to happen or something bad is going to happen, there is going to be volatility in the future that can affect the banking system. So the Reserve Bank of India can take the decision that right now in the current period, when the times are good, when the times are fine, when the banks are not under the distress, in the good times the banks should maintain additional buffer in the form of counter-cyclical capital buffer, so that when the bad time comes, the banks have enough of the money to sustain. Okay, so it requires banks to build up a buffer of capital in good times, which may be used to maintain flow of credit to the real sector in difficult times, in the bad times. Okay, the second reason, or the second aim of having the counter-cyclical capital buffer is it achieves the broader macro-prudential goal of restricting the banking sector from indiscriminate lending in the period of excess credit growth that is happening currently. What is happening? That there is excess credit growth. The deposit growth is not as high as the credit growth. So deposit growth in our country, the deposit growth in our country is not as high as the credit growth. The credit or the loans, the growth in the loans is happening way more than the deposit growth. So banks, in the form of deposits, the banks are receiving less money while they are giving more and more loans. Okay, so you can understand that the deposit growth is less than the credit growth, and that is becoming a problem. So it was said that the counter-cyclical capital buffers will be initiated, or the aim of counter-cyclical capital buffer is to achieve the broader macro-prudential goal of restricting the banking sector when the credit in the period of excess credit growth that have often been associated with the building up of system-wide risk. Sometimes what happens, like how many of you know about the 2007-2008 US financial crisis that became the global financial crisis? During that time, in this period, the banks of US were giving a lot of loans to the people that did not even have the capacity to return the loan, just because the housing prices or the property prices were rising. So there was a bubble that was created, that the house prices, real estate prices, property prices are rising, and it was increasing, and the bank started giving a lot of loans even to the people that do not have the regular income source or such. So in the US, it was seen that there was indiscriminate lending that happened, a lot of credit growth that happened, and when the housing prices started to decrease, many of the defaults started to happen, that many of the people, they were not able to give back the money and such. So it is said that CCyB, or the counter cyclical capital regime, it is required when there is the period of excess credit growth, when the excess credit growth is happening, that can create the system wide risk in the future. Right now it is good that excess credit growth is happening, credit is growing, many people are taking the loans, they are doing the demand in the country, production is increasing, and so. But if the demand keeps on increasing in a greater manner, the production might not be able to keep up, or the production might also increase and excess production can happen, and due to that the prices can decrease in the future. Right now, with the increase in demand, the prices are increasing. Okay, but in the future it can happen that the prices can start decreasing, or the system wide risk the banks can start facing because of the defaults that can happen. Okay, so these are the two reasons, or these are the two aim for the counter cyclical capital buffer. Okay, so the first one is the banks to build up buffer in the good times to handle the difficult times. The second one is that during the period of excess credit growth, the counter cyclical capital buffer can be introduced so that the banks maintain enough buffers to handle the system wide risk that can come in the future. Okay, so these are the two aim. Now counter cyclical capital buffer may be maintained in the form of, now I have told you that the CRAR is 9%. That has to be maintained in the form of tier 1 and tier 2 capital. Tier 1 is 7%, tier 2 is like minimum 7% of the capital has to be maintained in tier 1 capital, 2% in the tier 2 capital. Common equity tier 1 capital is 5.5%. Now, if the banks are maintaining the capital conservation buffer in the normal times, in the good times, the banks also have to maintain the capital conservation buffer, that is of 2.5%. That has to be maintained in the form of common equity tier 1 capital, because this is the most liquid capital that the banks have. Now, if the banks are mandated by the RBI to follow and to maintain the counter cyclical capital buffer, so this also has to be maintained in the form of in the form of common equity tier 1 capital, because this is the most liquid capital that the banks have to handle the distressful situation. So counter cyclical capital buffer may be maintained in the form of common equity tier 1 capital or other fully loss absorbing capital, the most liquid kind of capital only, and the amount of CCyB, or the amount of counter cyclical capital buffer, can be in the range of 0 to 2.5% of the risk weighted asset. Okay, so counter cyclical capital buffer, like the capital conservation buffer, has a set percentage, that is 2.5%, but the counter cyclical capital buffer, it can be in the range of 0% to 2.5%. Okay, so counter cyclical capital buffer, it may vary from 0%, it may vary from 0% to 2.6% of the total risk weighted asset ratio of the banks. Okay, so when the CCyB will be 0%, when the CCyB will be 2.5%, and what will happen if the bank do not maintain the CCyB if the RBI has mandated it. So all of this we will discuss, but till now, any confusion anyone has? Any confusion anyone? All clear? So CCyB decision would normally be pre-announced. It will, okay, So counter-cyclical capital buffer decision would normally be pre-announced with a lead time of 4 quarters. Okay. So RBI will pre-announce the decision of the counter-cyclical capital buffer so that the banks have enough of the time to maintain the buffers or to start maintaining the buffers. Okay. However, depending on the CCyB indicators, the banks may be advised to build up requisite buffer in a shorter span of time also. So it is said that normally the CCyB will be decided and pre-announced with a lead time of 4 quarters. But if immediately RBI feels that okay, the problem is going to come because US has taken this decision or China has taken this decision or the volatility is coming in the global level, so immediately also in the shorter span of time also the RBI can take the decision of implementing the counter cyclical capital buffer, but normally this will be the time period that will be given, but shorter span of time can also be taken for the CCyB. Okay, so now the indicators, like on what basis the RBI will decide that now we should ask the banks to maintain the counter cyclical capital buffer. So the indicators, the main indicator is the credit to GDP gap. So credit to GDP gap, first of all try to understand that what is credit to GDP gap. So credit to GDP gap, this is the difference between credit to GDP ratio in the current time period minus the long term credit to GDP ratio. Okay, let's say the credit to GDP ratio in the long period of time is 3%. Okay, that means credit to GDP ratio is 3%, while the credit to GDP right now is very high, it is 10%. So can you see the problem here? The credit to GDP ratio in the long term, we are expecting it to be 3%. That means out of the GDP, out of the total GDP, credit will be around 3% of the GDP. But right now, the credit to GDP ratio is 10%. So if we consider the long-term trend, the current credit to GDP ratio is too high. That means there is some problem that is coming. The credit is way high as a percentage of GDP or as a ratio of GDP. So can you see the problem? Can you see the problem here? So I hope you are able to see the problem. So this is the credit to GDP gap. This is the credit to GDP gap. Credit to GDP gap, this is the difference between the current credit to GDP with the long term credit to GDP. Okay. So credit to GDP gap is the difference between credit to GDP ratio of the current time period and the long term trend value of credit to GDP ratio at any point of time. Okay. So if the credit to GDP ratio at the current point of time is way more than the long term trend of the credit to GDP ratio, so that shows that there is some problem or there is excess credit that is happening. Okay. So credit to GDP gap, this shall be the main indicator in the counter cyclical capital buffer framework in India. However, it shall not be the only reference point and shall be used in conjunction with the GNPA growth, with the gross non-performing asset. Okay, let's say that the credit growth is happening. The credit to GDP ratio is way high at the current point of time. But let's say that good credit is being given with prudential norms being followed. That means the credit that is given to the people are able to return the credit. They have the capacity to return the credit. So then this kind of credit is good because this is for the growth of the country. This is given to the people that are engaged in production or they are engaged in productive activities or such. So this kind of credit, excess credit is good. So that's why the credit to GDP gap, this is seen with the GNPA, gross non-performing asset. Let's say the credit to GDP gap is increasing. There is more and more credit that is given, and with that, non-performing asset are also increasing. Then this is a problem. That's why whenever we see the credit to GDP gap, whenever we see the credit to GDP gap, we see it in conjunction with the GNPA growth. If the credit to GDP gap is increasing, this gap is increasing, but let's say the GNPA is low, the gross non-performing asset is low. That means non-performing assets are not happening, or there are very less non-performing asset. So less people are not returning the loan, while majority are returning the loan. So that means there is no problem. But let's say the gap is increasing, and with that the non-performing assets are also increasing. That means whatever excess loans that are given, that are problematic. So that's why whenever credit to GDP gap, this shall be the main indicator in the CCyB framework, according to which the counter cyclical capital buffers can be initiated and can be mandated for the banks to be followed. But this credit to GDP gap should not be the only reference point. It should be seen in conjunction with the gross non-performing asset growth. Okay. The Reserve Bank of India shall also look at other supplementary indicators like the incremental credit to deposit ratio. Let's say the credits are increasing, the credit growth is way high while the deposit growth is way less. So then it shows that there is some problem that is coming. The banking system does not have enough of the money in comparison to what they are lending. They do not have much deposits, but they are lending more and more, more and more, just to earn more and more, just to have some profits. Okay, so this is problematic. Okay. Next is industry outlook assessment index should also be seen. The industry outlook assessment index, this shows the mindset of the manufacturing industry. Okay, let's say the manufacturing industry, as per the assessment, as per the industry outlook assessment index, the manufacturing industry is showing optimism. That means they are showing positive outlook. That means they are willing to do more and more production. They are doing the capacity building. They are buying more capital to do more and more production. So that is good. That for the productive sector the credit is given, to the manufacturing sector the credit is given, as they are optimistic for the future, as they are trying to do more production. But let's say that the industry is pessimistic. They are having negative sentiments. They are having negative sentiments. They do not want to like increase their production. Then where the loan is being given if the credit is increasing? That means the loan is given to non productive sector. So that is problematic. So industry outlook assessment index should also be seen, as if the assessment is showing that industry is having an optimistic outlook, that means more and more credit has to be given to increase the capital base in these industries and to increase the production. But if the industry is pessimistic, that means the industry do not want to exceed their production, do not want to do more production, then the credit is flowing to the wrong direction. Okay, so this is the idea. Next is interest coverage ratio. Interest coverage ratio means that the manufacturing sector that have taken the credit, do they have the capacity to pay the interest? Okay, so this is the interest coverage ratio, that is seen that the people that have taken the loan, do they have the capacity to pay the interest? So these are some supplementary variables or indicators that can be taken into account while deciding for the counter-cyclical capital buffer to be initiated. While taking the final decision on the CCyB, the Reserve Bank of India may use its discretion to use all or some of the indicators along with the credit to GDP gap. This is the main indicator, in conjunction with the GNPA growth, and these are the supplementary indicators. Okay. So now let's discuss. No, these are the supplementary indicators that I have shown you. Okay. Now, the CCyB framework shall have two thresholds. As I have told you that the counter-cyclical capital buffer, this is within the range of 0 to 2.5%. So 2.5% is the highest buffers, additional buffers that the bank has to maintain. 0 is the lowest additional buffers that the bank has to maintain. Okay, so there is a lower threshold and there is a upper threshold with respect to credit to GDP gap. The bank should maintain 0% of counter cyclical capital buffer, or the bank should maintain 2.5% of the counter cyclical capital buffer. This depends upon the credit to GDP gap. Okay, so that we have to see. So the lower threshold of the credit to GDP gap, the lower threshold of credit to GDP gap, where the CCyB is activated. Okay, let's say CCyB is activated at 0.1%. So at what like how much the credit to GDP gap should be? How much the credit to GDP gap should be? What is the lower threshold? What is the lower threshold of credit to GDP gap where the CCyB, where the counter cyclical capital buffer will be activated or will be initiated? Okay, so that we have to understand. So the lower threshold of the credit to GDP gap. So credit to GDP gap is the credit to GDP ratio of the current period minus the long term trend of credit to GDP ratio. Okay, let's say the long term credit to GDP ratio is 5% and currently credit to GDP ratio is 9% or 8%. Okay, so there is the difference. The credit to GDP gap is 3%. So lower threshold of the credit to GDP gap where the CCyB is activated shall be set at 3 percentage points. So as soon as the credit to GDP gap is 3 percentage points, that means there is the 3 percentage points of difference between the current and the long-term trend of the credit to GDP ratio. So then the counter-cyclical capital buffer is initiated if the gross non-performing asset, if the non-performing assets are also significant, they are also rising, or they are also massive. Okay. The buffer activation decision will also depend upon other supplementary indicators, but this is the idea that this is the lower threshold of the credit to GDP gap. If it is 3 percentage points, then the CCyB can be initiated. Then the CCyB can be initiated if the non-performing asset is also high. The upper threshold where the CCyB reaches its maximum. So upper threshold where the counter-cyclical capital buffer is reaching the maximum. So counter-cyclical capital buffer is within the range of 0 to 2.5%. So the maximum of counter-cyclical capital buffer will be initiated once the upper threshold of credit to GDP ratio has been met. If the credit to GDP ratio, if the credit to GDP gap is 15%, let's say credit to GDP gap, this gap has reached to 15%. That is a very huge gap. So upper threshold where the CCyB reaches its maximum of 2.5% shall be kept at 15 percentage point. That means if the credit to GDP gap reaches 15 percentage, then the 2.5% of the counter-cyclical capital buffer will be initiated. Once the upper threshold of the credit to GDP gap has reached, this counter-cyclical capital buffer shall remain at its maximum value of 2.5% of the risk-weighted asset till the time of withdrawal is signaled by the RBI. In between 3 to 15 percentage points, the counter-cyclical capital buffer will remain within the range of 0 to 2.5%. Okay, let's say the credit to GDP gap is 10%. So that is, we can say, on the higher range. So the counter-cyclical capital buffer can be kept, let's say, at 1.5% or 2%. Okay. So in between 3 and 15 percentage point of credit to GDP gap, that means within the lower threshold and upper threshold. If the credit to GDP gap is in between lower threshold and upper threshold, the counter-cyclical capital buffer shall increase gradually from 0% to 2.5% of the risk-weighted asset of the bank, but the rate of increase would be different based on the level where the credit to GDP gap is. If it is near to the upper threshold, then the CCyB should be on the higher range. If it is near to the lower threshold, the CCyB should be on the lower range. If the credit to GDP gap is below 3%, then there is no need of the counter-cyclical capital buffer. Okay, so this is the idea. Any confusion here, anyone? Any confusion? Now, the banks will now let's say RBI has said that the banks have to maintain 2.5% of counter cyclical capital buffer. Let's say the bank is not following this counter cyclical capital buffer, the bank is not maintaining this counter cyclical capital buffer. Then what should happen? So banks will be subject to restrictions on discretionary distribution. So bank will be restricted on how much bonus payments they are doing, how much share buybacks they are doing. Let's say Reliance has said that we will buy back our shares, so that will be restricted. If the not Reliance is not a bank. Let's say State Bank of India has said that we are buying back our shares, but the State Bank of India is not maintaining enough of the counter cyclical capital buffer at 2.5%. So the RBI will say no, use your money to maintain the counter cyclical capital buffer. First maintain this, then you can buy back your shares. Okay, so banks, if they are not maintaining the counter cyclical capital buffer that is decided by the RBI, then the RBI will put restrictions on their discretionary distributions. That may include the restriction on the dividend payments, how much profits, the part of profit, that is the dividend, that goes to the shareholders. So this will be restricted. Share buybacks will be restricted. Bonus payments will be restricted if the bank do not meet the requirement on counter cyclical capital buffer. Okay, so this is the basic idea, that the banks will be subject to restrictions on discretionary distribution, on the distribution of their dividend payments, share buybacks, staff bonus payments. So this will be restricted if they do not meet the requirement on counter cyclical capital buffer, which is an extension of the requirement of capital conservation buffer. So capital conservation buffer is 2.5%, and the counter cyclical capital buffer, this is within the range of 0 to 2.5%. Let's say RBI has mandated that the banks have to follow the maximum of counter cyclical capital buffer at 2.5%. Okay. So let's say that the bank, let's say this is the table that is showing you that common equity tier 1, the banks have to maintain common equity tier 1 of 5.5%. Let's say the capital conservation buffer is 2.5% and counter cyclical capital buffer is 2.5% that is mandated by the RBI. But let's say the banks are following 5.5% to 6.75% of common equity tier 1 capital. That means they are not completing their capital conservation buffer and counter cyclical capital buffer. They are not maintaining both of these completely. Then 100% of restrictions will be imposed on their discretionary distributions. Discretionary distributions will be 100% restricted. If the capital equity tier 1 ratio is within 6.75% to 8%, so again they are not maintaining, because common equity tier 1 capital within the CRAR is 5.5%. 2.5% of capital conservation buffer means 8% in total. With the capital conservation buffer, 2.5% of counter cyclical capital buffer means 10.5%. This much in total common equity tier 1 capital they should be maintaining, if with the counter cyclical capital buffer being 2.5%, let's say. Okay, so here they are not maintaining the complete of the counter cyclical capital buffer. So 80%, this is the restriction. This is the restriction. 80% of their discretionary distribution is restricted. Only 20% of the discretionary distribution they can do now. Let's say the common equity tier 1 capital is in between, is greater than the 8.0% to 9.25%, then they are allowed. That means they are maintaining some of the they are maintaining the capital conservation ratio and some of the counter cyclical capital ratio. So here 60% is the restriction, 40% is allowed for the discretionary distribution. If they are within this range and they are making more of the common equity tier 1 capital from this range, then 40% of restriction is there. 40% of the restriction is there that should go to the capital conservation ratios, and 60% of the discretionary distribution can happen. Okay, so this is the basic idea, that here in this table it is shown that if the counter cyclical capital buffer is, let's say, 2.5%, and the capital conservation buffer is always 2.5%, so common equity tier 1 capital, if it is greater than this range, then 100% of restriction will be there on the discretionary distribution. If common equity tier 1 ratio is greater than this range, then 80% of the restriction will be there on the discretionary distribution. That means only 20% will be allowed for discretionary distribution. If it is within this range, let's say it is greater than, now common equity tier 1 capital is 5.5%, 2.5% of CCyB, and 2.5% of counter cyclical capital buffer, that is 10.5%. So let's say common equity tier 1 capital is 10.5 greater than 10.5%. So 0% of restriction will be there, and discretionary distribution can be 100%. Discretionary distribution can happen at whatever level the bank want. Okay, so this is the idea. Now how the ranges are decided. Now these were the ranges, right? That if the common equity tier 1 is greater than this range, is greater than this range, or greater than this range. So how the ranges are decided? So ranges are decided on the basis of that common equity tier 1, the minimum is 5.5%. Now CCyB, that capital conservation buffer is 2.5%. Counter cyclical capital buffer is 2.5%. Okay, so 25% of counter cyclical capital buffer, 25% of capital conservation buffer, that is 0.675, and 25% of CCyB, that is 0.675. So in total this is 1.5 1.35 or 25. So in total, this is taken, and 5.5% plus 1.25. Okay, so this is how the range is decided. This is how the range is decided. Okay, and that it is 5.5% plus 25% of capital conservation buffer, 25% of counter-cyclical capital buffer. So the CET1 ratio bands are structured in increments of 25%, okay, of the required CCB and CCyB prescribed by the Reserve Bank of India. So 25% is taken of the capital conservation buffer, 25% is taken of the capital counter-cyclical capital buffer, and the range is decided on that basis. Okay, so this is the idea. Any confusion here, anyone? Any confusion? Okay, okay. Any confusion here? So I have shown you that if the bank is not able to follow, if the bank is not able to follow the capital conservation buffer or counter cyclical capital buffer, so the bank will be the restrictions will be on the discretionary distribution, on the share buybacks, bonus payments, and the dividend, and how much the restriction will be. So if the range is decided. First of all, common equity tier 1 capital is minimum 5.5%. Now CCB is 2.5%. CCCB is, let's say, 2.5%. So 25% of uh, CCB, that is 0.625 percent, and 25% of counter cyclical capital buffer, that is 0.625. So this is added, so that is 1.25%, so that is 6.75%. So this is how the range is decided. Here also you can understand this 6.75% plus 1.25%, so that is 8%. Okay, that is 8%. So this is how the range is decided. Let's say counter cyclical capital buffer. Now this is going to remain the same. Capital conservation buffer is going to remain at 0. The capital conservation buffer is going to be 2.5%. So 25% of 2.5% is 0.625%, but capital conservation buffer, the counter cyclical capital buffer, is, let's say, 1%. It is not 2.5%, let's say it is 1%. So 25%, the 25% of 1%, 25% of 1% is 0.25, is 0.25. Okay, so then 0.625 plus 0.25. So this is how the range is decided. Okay, this is how the range is decided. Like just add this in the 5.5%, 5.5%, add this. So then the range will be decided for the new table where the 25% is taken for the CCB and CCCB for the range. Okay, and 100% first, if it is within the range of first tier, so it will be 100% will be the restriction, and discretionary spending or the discretionary distribution will be 0%, and so the range will remain like this. Okay, so this is the idea. I hope this is very much clear. Now, for all banks operating in India, the counter-cyclical capital buffer shall be maintained on a solo basis. That means each bank, if the counter-cyclical capital buffer is 1%, or if the counter-cyclical capital buffer is 2.5%, the banks have to maintain it on the solo basis also, and in the aggregate level also, for all the banking system taken together, the CCCB should be maintained. Okay. Next is that the all banks operating in India, both foreign and domestic banks, if they are operating in India, should maintain capital for Indian operations under CCCB framework based on their exposure in India. Basically, if a bank is operating in India, they have to maintain the counter-cyclical capital buffer on the basis of the framework of India and on the basis of exposure that they have in India. Okay. So credit flow, if the CCyB is activated, if the counter-cyclical capital buffer is activated, the banks will have to maintain more buffers with themselves, so they will have less money to lend. They will have less money to lend. So RBI has decided right now to not initiate the counter-cyclical capital buffer. By not activating this buffer, the RBI is ensuring that there are no hurdles in the flow of credit to the productive sectors of the economy, so that the credit can continue in the economy. Okay. I hope this is clear. So now, any confusion, anyone? Before going to the questions, I will show you the questions. Anup is saying, if CCCB is fixed, RBI is 40% capital conservation buffer. If let's say the counter cyclical capital buffer is 1%, so common equity tier 1 capital is 5.5%. This is the minimum under the CRAR, plus 2.5% of the CCB and 1% of the counter cyclical capital buffer. So it is 9%. Okay, 9% common equity tier 1 capital is 9%, right? It is 9%. Okay. And the range will be decided on for the restrictions if the bank is not following the capital conservation buffer or counter cyclical capital buffer. So the restrictions will be decided on the basis of the range that will start from the minimum of the common equity tier 1, and the range will be 25% of 2.5%, 25% of 1%. So that is around 0.925 or something, plus 5.5%. So the range will be around 6.25% or something. So, and the range will continue. So for the first, it will be 100%, then 80%, and so on and so forth. Okay. So this is how it will happen. Okay. Now this is, see, many of the students, they ask that how they can practice the answer writing. So for that, Jaskaran sir has brought the descriptive answer writing sessions that is under the Perspective 360-degree series that is available in YouTube, and it is available on Monday, Wednesday, and Friday at 5 p.m., where you can see the sessions and you can know the art of writing the answers, as well as you can also practice that how to write the answer. The homework questions are given where you can write your answers, where you are writing your answers, as well as your answers will be evaluated that you leave in the comment section below the video. Okay, so below these videos, the answers that you are leaving, that are also getting evaluated free of cost. So these sessions are for your answer writing practice. Okay, so do join these sessions. Now this is the first question. I hope you will be able to answer this question. If there is any confusion, you can write down in the comment section. And this is the first question. Try to answer this question. Okay, and this is the second question. Again, try to answer this question, that what can be the answer of this question. I hope all of you know the answer of this question. So thank you very much. Do give the right answer of the homework question. If there is any confusion, do tell me in the comment section below. Okay, so this is it for today. Thank you everyone. Thank you for joining the session. See you in the next session. Okay, thank you everyone. Thank you for joining. Do comment if you have any query. Do comment down below in the comment section. Okay, thank you everyone.